The IRS just released the new 2026 limits for every major retirement account. And unlike 2025, we have good news across the board. Every account got a bump. Your 401k, 403b, IRA, and even those sneaky powerhouse HSAs. These new limits are your chance to squeeze even more compounding out of these tax-advantaged accounts. In this video, we'll break down exactly what's changing, how the new contribution room affects your long-term wealth, and how to prioritize Roth versus pre-tax depending on your situation. There's no one-size-fits-all answer, but after this video, you'll know which direction fits you. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. This video is brought to you by me. So tap that like button, subscribe if you haven't already, and consider joining the channel membership to keep this section short and sweet. You know what time it is. Let's grow. 401k Basics. For most people, myself included, a 401k or a 403b is the most reliable wealth building tool we have access to. It's simple, reliable, and designed to quietly build your wealth in the background as you live your life. Now sure, you can build wealth faster through entrepreneurship, real estate hustle, or high-risk, high-effort investing. But for millions of us normal people out there that just want to focus on our career and take care of our family and enjoy our free time, a 401k is the ultimate set it and forget it compounding machine. And unlike most investments, a 401k often comes with something extremely rare in finance: free money in the form of an employer match. Most of your contributions go in pre-tax, which lowers your taxable income immediately. This means that you save money right now, not years down the road. For example, when you contribute $500 a month to your 401k plan, your actual paycheck may only drop by about $400 depending on your tax bracket. That difference is your instant tax benefit at work. You're pushing those taxes into the future, usually all the way to retirement, when many people find themselves in a lower tax bracket, meaning that those deferred taxes often cost you less later than they would today. And all those features work even better as the contribution limits rise, something that we're getting in 2026. Let's cover that now. 2026 401k changes. The IRS raised the employee contribution limit for 401k or 403b plans to $24,500 in 2026. That's a 4.3% increase from the 2025 limit of $23,500. And this $1,000 increase stands out because the last couple of adjustments were only $500 each. It's nice to finally see the limits moving a bit more aggressively. The catch-up contribution for workers 50 and older is also increasing in 2026. It's rising to $8,000, up from $7,500. And that special Secure 2.0 catch-up for people 60 to 63, very precise age range, remains at $11,250. And for those of you that are self-employed, the combined employer plus employee contribution limit also increased for 2026, moving up to $72,000. And if you're self-employed and 50 or older, you can also add that brand new contribution catch-up limit of $8,000 to your total, making it a nice smooth $80,000. And finally, if you hit the perfect storm of being self-employed and from the ages of 60 to 63, you're able to use the enhanced $11,250 catch-up instead, bringing the total to $83,250. This wraps up the 2026 401k changes, a plan that mints more millionaires than you'd ever expect. But let's hop over to one of my other favorite retirement accounts, IRA Basics. IRA stands for Individual Retirement Account, and technically the A stands for Arrangements, but nobody uses that. You'll typically hear about two types of these accounts. You have the traditional IRA and the Roth IRA. Both accounts offer tax advantages that you don't get in a regular taxable brokerage account. With a traditional IRA, your contributions lower your taxable income in the current year, giving you that immediate tax relief. And with the Roth IRA, you pay taxes up front at your marginal tax rate, but your future withdrawals are completely tax-free. Think of the Roth as behaving like a taxable account today with the huge perk of tax-free income later. There's no age restriction to contributing to an IRA. You can contribute at 18 or 88. as long as one key requirement is met. You need to have earned income for that year that is at least equal to the amount that you contribute to the account. You can't contribute more than you make. And lock in here because this part is important. You are able to max out both a workplace plan, like a 401k, and an IRA in the same year. These limits are completely separate. And one more important feature about the Roth IRA specifically, you can withdraw tax and penalty free your contributions made over the years to the Roth as long as the account is at least 5 years old. Just remember that the rules do get a little nuanced when it comes to earnings in the Roth and conversions, so make sure you have a full understanding before making any withdrawals. Now it's time to see what happened with these things recently. 2026 IRA changes. For 2026, the IRS finally increased the IRA contribution limits from $7,000 up to $7,500, a small but welcome change. And alert the press, the catch-up contribution for people age 50 and older finally moved up by, wait for it, $100. It increased to $1,100, bringing the total contribution limit for those 50 and older to $8,600. The IRS also adjusted the income limits for Roth IRA eligibility. So I'm out here on the NerdWallet website, and you can see here we're in the Roth IRA Contribution Limits 2026 section, and we're going to focus right here on this middle column, which is the Modified Gross Adjustable Income Limits for being able to contribute to a Roth IRA in general. You can see if you're single, head of household, or married filing separately, and you make less than $153,000 per year, you're eligible for the full contribution, $7,500 or $8,600 if you're 50 or older. And then there are thresholds here. So if you're between 153 and 168K, your contribution is reduced. And then if you make over 168,000, you are not allowed to contribute directly to the Roth. And then in the married filing jointly and surviving spouse section, if you make under $242,000 a year, you can do the full contribution. And then the range for a reduced contribution is $242 to $252. And then if you combine for over $252,000 of income, you're not allowed to directly contribute. And then the last one down here is married filing separately. If you make over $10,000 here, your contribution is reduced, and $10,000 or more dollars earned, no contribution allowed. These higher thresholds give more people eligibility for Roth contributions before phasing out. If your income does exceed those limits, there's still a path to fund the Roth IRA via the backdoor Roth IRA strategy. But just be cautious here because this method isn't ideal for everyone's situation and it can cause some unexpected tax complications. Make sure to do your research and talk to a tax professional if you're unsure. Personally, I loaded up on the traditional contributions during my high earning years, and I plan to execute Roth conversions in retirement when I'm in the lower tax bracket. Pre-tax versus Roth. Choosing between pre-tax and Roth is one of the biggest decisions us investors can make, and unfortunately, a lot of us roll with our gut decisions or what we heard casually from others instead of running the math. You guys know I'm basically a spreadsheet with a beard, so I don't leave this to instinct. This has been analyzed, modeled, and sanity checked like everything else I do. At the highest level, the entire decision really comes down to one primary question. Will your marginal tax rate be higher today, or will it be higher later when you're retired? There are plenty of advanced tax strategies out there like Roth conversions, withdrawal sequencing, and RMD planning that will play a key role in your retirement. But at the end of the day, every one of those strategies will produce more ordinary income, just like your job does today. Which brings us right back to the core variable, your tax bracket now versus your tax bracket in the future. Here's a simple example that a lot of people will overlook. If you're in the 22% tax bracket now as you earn your money, and you're in the 22% tax bracket somehow, that's pretty high, in retirement when you withdraw the money, a traditional IRA and a Roth IRA will get you to the dollar equal purchasing power. A lot of people instinctively gravitate towards Roth because tax-free forever sounds magical. And it's a catchy idea, but it glosses over something important. Every dollar that you lose to taxes today is a dollar that never gets a chance to compound. Let me show you what I'm talking about. Okay, and we are going to be keeping this very simple. I didn't prepare anything in advance, but we're going to do this together on the fly. I will say that there are a lot of retirement calculators out there online, so you can validate what I'm about to show you here just on the basics of how Roth and pre-tax works versus one another long-term for purchasing power online. So please feel free to audit everything. Now, in this simple scenario, we are going to assume $1,000 a month of contribution between 401ks and IRAs. They both function the same as far as pre-tax versus Roth. So to keep it clean and simple, $1,000 a month into the traditional 401k and IRA. So we're going to start with $0 invested. We're putting that $1,000 a month and assuming a 10% growth. And we're going to use 40 years in this spreadsheet. And I really am doing this on the fly. I think it makes it a lot more fun. So after 40 years of investing $1,000 a month into a pre-tax account, you never pay a penny of tax yet. We're just going to reference these numbers. You would have invested $480,000 and its ending balance is $6.324 million. And again, that's assuming a 10% growth, $1,000 a month for 40 years. You can audit this with an online calculator. This thing is accurate. And that is what you have before paying taxes. So we're just going to take this and then paste it as a value. And right now that's our figure before considering the withdrawal taxes. With the Roth, we're going to take those taxes real time. So we're doing $1,000 a month times 0.78. We're in the 22% tax bracket. So 780 is working for us. The other is 220 per contribution is paid for taxes in that year. And you can see that we end at a much lower 4.932 million. But the beauty is this number here is tax-free for life. So we're just going to carry it over as our final balance here as almost 5 million. Now for this, we've never been taxed. So if we assume a 22% tax rate as we're withdrawing the money, let's just do the math here. So we have a 22% tax and we'll just go 1 minus 0.22 times our initial amount of 6.3. And lo and behold, we end at 4.932782. It really will be to the dollar. And the point of all of this is whether you're taxed 40 years in for the first time ever on the whole amount, or you're taxed in that 22% bracket as you're earning money throughout your career as you make the contributions, the net math is weirdly the same. A lot of people assume that the Roth gets you ahead because this is tax-free forever, but they forget that there are fewer dollars working for you. And realistically, this percentage will very likely be 12 or whatever that tax bracket is and lower on the majority of your conversions and your withdrawals. Since we can't cover every individual tax scenario in one video, here's a general framework to help guide your decision. If during your working years now, you're in the 10 or 12% tax bracket as your marginal rate, make Roth contributions, and that's a no-brainer. Now, on the other end of the spectrum, if your marginal tax rate is 32 to 37%, it's highly likely that it's a no-brainer that you need to make pre-tax traditional contributions. And for all of us normies out there in the 22 to 24% tax bracket, you could go either way. For most of us in the middle zone, that 22 to 24%, I would recommend going with traditional or pre-tax contributions. The reason is simple. Contributing during your peak earning years lets you save real tax dollars at your highest marginal tax rate. That boost shows up in your paycheck by reducing the taxes paid this year, and that ultimately gets more of your money compounding in the background for decades to come. And here's the ultimate tiebreaker. Most normal people that worked a normal career in the 22 to 24% tax bracket will ultimately be able to withdraw or convert that money in the 12% tax bracket or lower in retirement. And if you don't end up in a lower tax bracket, honestly, that means you built an incredible financial foundation. That's a good problem to have. All right, let's move into the final section of this video to see how all this impacts your long-term wealth. Impact on your wealth. Building wealth through investing feels painfully slow when you're new. Compound interest is sneaky. It works quietly for years before it suddenly looks like an overnight success. We see people with millions of dollars and we think, well, sure, if I had that money to work with, I could compound my wealth pretty easily too. But the truth is, most millionaires didn't start with all that money. They built these simple systems that we talk about on the channel and they let it play out for multiple decades. And for everyday people like us, a 401k, especially when you have access to a low-cost S&P 500 fund, is the best engine to get the snowball rolling. But here's the part that few people emphasize and most people miss. You can't just set up your 401k and consider it good forever. You need to challenge yourself to increase your contributions each and every year. Every raise or promotion or bonus, increase your contributions until you hit that max. I've shared this story before, but when I started at Boeing, a coworker told me, max your 401k, period. Find a way. And I remember thinking, oh, sure, let me just go grab money from my money vault that I have in my man cave, because that definitely exists right now. But he was right. My wife and I crossed the $1 million mark in our 401ks after just 15 years. And we tried our best to max them. We couldn't until about 2017 or 2018. But we always pushed ourselves to budget smartly, live within our means, and increase that contribution each year. I work with people today who have 1 to 3 million in their 401k after 40 years of working, sometimes with dual income households. And when I run the backtest on their actual timelines, their original funds, and their contribution history, I often find that maxing their 401k 10 years into their career would have over doubled their final balance. These numbers are real, and yes, I did adjust for the lower contribution limits at the time. So here's my challenge to you, and I mean this sincerely. Max that thing out. Find a way. I'm your smug coworker now, giving you the same push I received years ago. And I promise you that you will thank me later. And speaking of thanking people, a huge thank you to you 32. We grew a little bit. Amazing channel members. And a special big thank you to the new, albeit technically returning channel members, R, Paul, and Manny. You channel members are the best. And check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.